Good morning, everybody. As you can see, it's 10:25 on Sunday, May 28th. Happy Memorial Day, and special thanks to all of those who have served. Um, we wouldn't be here without you and others like you. This is my weekend review. It's dated today, 5/28/2017. Obviously, it's Sunday morning on a holiday week, and the futures are not open. There was an interesting pop in the NASDAQ futures after the market closed. I don't know if it's an aberration, but we'll see come Monday. I titled today, Sell in May, Not This Year. Wow, what another great month. This has been, for me, one of the best years ever. And it's only 5 months in. We'll see how we end up. And I may make the mistake of sharing some of my account information today only because I'm really pissed. Hopefully someone will answer that phone, because I'm really upset about something that I watched this weekend and really pissed me off. More about that coming. Again, my name is Jeffrey Scott, and my email address is hgsidoc@gmail.com. I call it a top-down review because if you haven't been here before, I'm really about top-down markets, industry groups, and then stocks. Disclaimer, this is educational purposes only. Any recommendations in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm truly independent. I'm not associated with any software vendor or trading company. Tools demonstrate those that I use in my daily trading. I have paid for everything I use. To be very fair, honest, I have bought a ton of shit, and I use very few, and most of the stuff that people sell you is garbage. Again, carryover from my being pissed off from something I listened to yesterday. And trading involves risk, and you alone are solely responsible for any investment decisions you make. This theme of be your own guru, I'm going to have another slide that talks about it. And just for background's sake, I'm like any other person. I'm not a business guy. But I have a profession. I quit practicing a long time ago and went into business. And I had the fortune in the late 90s meeting this guy right here. His name is Ian Woodward. The world lost Ian, at least Earth lost Ian, not heaven, about a year ago. Ian was just a brilliant man who could look at a lot of things and just tell you the way it was. And so much of what I do, I have to give credit where credit's due and thank Ian. And part of why I do these webinars and I try and help people with HGSI is just to carry on his legacy. A wonderful man. He grew up, as I did, watching William O'Neill and paying attention to Cancelim. Ian and his partner Ron Brown helped George Roberts build HGSI, and HGSI does many things. One of the things it does is a great electronic implementation of Cancelim trading. Plus, Ian, in his own special way and special vocabulary, really upped the game of Cancelim, in my opinion. Speaking of up the game, the O'Neill disciples, Morales and Katcher, also came up with things like pocket pivots, Bible gap ups, punch bowl of death, voodoo setups, all kinds of. Everybody likes to make their own names. That's pretty clear. So part of what I do is well trenched in Cancelim, although it's not the same as the Cancelim that people might be doing on a Palatuma board or some other board. I've become my own guru. More about that to follow. This is George Lee, and George is a good friend, a great trader. We've had the opportunity of sharing podiums together several times. And, George and I end up finding the same stocks and trading them 100% differently, and we both make a lot of money trading, which is kind of fun because it really points out there are many ways to find what's working and many different trades you can take with it, and you do what works for you. Up here is Van Tharp. He has a whole series of books. I highly recommend them. I mean, I still have issues that I have to do better. I have to do better at avoiding big losses. Now, like I said, I'm probably going to share more with you today than I normally share just because I'm really pissed off because it's something I'm listening to over the weekend. But I'm going to read Super Traders again just so I can get better at avoiding some of the big losses. Now, the reason why I may occasionally get a big loss is because I get some really monster wins. And at the end of the day, it's how much money I make, not what my win-loss percentage. I don't even care about that. I'd be happy to be stopped out with small losses to have a few big ones. But all you got to do is be riding the leaders and take as much as you can. But I can clearly do better at cutting some of my losses early, and it's something. That's always been my problem. But in the context of I make decent money in the market, and then a more practical approach today might be what John Person does. John is a friend of mine now, but I was, I think, his first customer for his annual package of indicators and his lifetime package of indicators. I've been mentored by him. I've gone to his live seminars. I've read his books, and John has this great way of, well, his stuff matches my style. He has a great momentum indicator called PPS, buy and sell signal. He taught me about pivots and last conditional changes. He introduced me to high close and low close dojis, which are in themselves a great trading system. And I incorporate his scans and his indicators every day when I do my trading. We'll define what every day means in a few minutes. I have almost every program on the market. I am the sucker that when they do their, normally $19.95, today only $7.95 for this incredible indicator that's going to change your life. I'm the idiot that's usually buying it, mostly because I have too much dispensable income or disposable income, and I don't care, but I'm always looking for the Holy Grail. Hint, it doesn't exist. I end up using just a couple. TradeStation, Thinkorswim are always on. Genesis, I like the charting and some of the scanning, but most people don't have it. HGSI is my aftermarket and delayed intermarket analysis tool. No, I don't think you can do just as well with FinViz. EdgeRater automates some of the things I used to do in Excel and has a lot of other value. Yes, I like seasonality. This is not a great time for seasonality. There are certain picks during the year that I just love that I take, and we may or may not, based upon how much I rant or rave, look at some of that today. And there's a number of websites I use. Add this to ovitrader.com, flagcharts.com, and others. And also, I got to update my slide. I just took call Guy Cohen. Just Google him. You probably get a lot of junk mail from him. Guy's got some, for those of you that don't want to work that hard, that are looking for a web-based scan that can identify you some of the stocks that I find and give you some added help with his OVI indicator and some great education, I would look up Guy Cohen, flagtrader.com and ovitrader.com. Highgrowstock.com, again, I make no money on this. I have no ownership. I have no stake. I don't get anything if you do something. This is what I like to support as part of my pay homage to what I got out of Ian. Ian was fundamentally involved in putting this together. And if you go up here under investing strategies, you'll see, you don't have to log in to do that, by the way. You'll see a number of videos by me and Ron Brown. Ron and I trade differently. Ron is all about VSA today. But he's built into HGSI the same tools that you'd be paying $4,000 or $5,000 usually to some crazy guy in England for his volume spread analysis tools. If you go to the free 30-day trial, they don't even ask you for a credit card, which is bizarre in this day and age. So here we are again. And why do I show this? I don't always remember to point this out, but this basic pattern will occur over and over and over and over again in industry groups, stocks, indexes, sectors, and it's fractal. It could be in tick charts, minute, day, etc. And stocks go up and stocks go down. Whenever you start thinking to yourself, it's different this time, that's usually a time to kick yourself in the ass and start thinking about getting out of the trade, because it hasn't changed in years. It's not going to change now. We felt on Wednesday last week, not this recent week, but a week and a half ago, 10 days ago, must have been like the 17th or something, it really felt like we were about to enter a major correction. We had a major down day, and then big shocker, we opened up a little bit below it the following day and closed higher on the day. And now, 7-8 days later, we've taken out the highs of the market, except for the Russell, which lingers. You have to know where you are because you're going to play the market differently. That was a quick whipsaw. As I've said several times, what hasn't looked like this as much as it's looked like it's rolling over and it takes off again. It looks like it's rolling over and takes off. And so what we've really done is we've missed this section here where the red arrow down is, and we just keep going through this pattern here. We'll have our correction day, and why this matters is because you got to know how to play it, and I play it differently. And I'm pretty long right now. As I said last week, I had some spider puts and I had some VXX puts, and I cover them on Monday because nothing bad happened over the weekend. And I do that frequently. So, a couple of different slides. In the words of my mentor, Ian Woodward, be your own guru. Here's a couple of my thoughts. There are no magic indicators, foolproof trading systems, or free lunches in trading. Education is the key to getting a good foundation. There are some very good teachers out there, but remember, you ultimately hold your own responsibility. Ask yourself if whomever it is so great, why is he taking time to sell indicators and education? I'm going to, without naming names, call out what I saw this weekend that really pissed me off. This is a guy, don't know anything about him personally, who showed up within the last couple of years, and he has a new site. He had a prior site, and this is a new site, and he does a lot of education. He sells a lot of indicators, and I fell for it, and I bought his indicator. It's called the Best Indicator Ever, maybe a month ago. Now, he doesn't charge much. It retails for, I'm going to make these numbers up so you don't give it away, $19.99, but you could have it today for $3.99 type of a thing. And so he's on his webinar yesterday, and the first thing he says is, well, he only uses his Best Indicator Ever to, he doesn't do futures with it. He doesn't swing options, which is what I do and others do. He doesn't day trade stocks. What he does is he day trades, he swing trades like 4 or 5 stocks, and that's it. Now, I ask you, if it's the world's best indicator ever, why would it only work on 4 or 5 stocks? Then the best part was he said that he apologized because he lost $70,000 in the last 2 weeks. Now, I'll be honest, I'll sometimes lose $70 in a week, $70,000, because my trading account is kind of robust, and that would be about 3.5%. And I've had those weeks. But then he showed his trading account, and he had $40,000 account. He was down on the year, which he admitted. So if I do the math, he had $110,000 in his account a week ago, and his trading knocked it down in 2 weeks from 110 to 40,000. Isn't there something wrong with that? Now, I'm just going to show you one thing. I will in a second. So I think you got to know who's teaching you. You can't rely on the hype, and you got to find what works for you. Find what works for you is key. I look at multiple time frames. I swing trade. I look at weekly charts for strategy, plan my tactics on the daily, and if I'm at my screens, I'll go down to 60 minutes to fine-tune my entry and exit. I like to have a life. Even when I retired, which I failed, by the way, I couldn't day trade. I couldn't sit at my charts all day long. I like to do things, whether it's hanging out with my wife or my dog or going out and buying stuff or traveling. I don't want to sit at my computer. So I had to design a trading plan that fit my lifestyle. Create your trading plan, stick with it. And then this is probably one of the most important things that Ian ever did. And he would stand up in the front of the room, pretend he was Kenny Rogers, and sing about know when to hold them, know when to fold them. Willie, whoever it is, I think it's Willie. And the reason why that's important is I'm not in the market all the time. I'm in the market when it works. If I start losing on a bunch of trades, if I have a 3% down next week, well, that means I'll only be up 32% or 33% on the year. I can live with that. But if I'm down 3% 2 or 3 weeks in a row, I'm going to empty out my account and go to the sidelines because what I'm doing is not working. And then I'll come back with some small trades, and when they're working, I'll build my account up. You don't need to be in all the time, and when your market's going down, why if you're losing every week, then how is that investing? That's called losing. My trading plan. I think this is important because you're listening to this for whatever reason, and you need to know how I think, and I'm probably different than you. My goal is growth and speculation. I may call out dividends from time to time, but since I'm mostly swing trading options, I never see those dividends. But clearly, once in a while, you'll have that outsized dividend that for some of you that might be important. Money management. This is critical. We're different, but I think you can learn from this one. Assume your account size is X, and I'll use 200,000 for X right now. I'm willing to risk 2% of my account on any trade. 2% of X for me is about $4,000. If a stock is at 20 and my stop is at 19, which would be a 5%, then I'm willing to buy, and that's the formula, $4,000 risk divided by 1, which is the distance between my buy price and my stop, allows me to buy 4,000 shares. Once I'm in a position, I use 3 + 1 stops. Stop number 1, I set a stop based upon the chart and usually just below support and no more than 8% away. I try and always do an example of that in my get on a train playing trades that I do. The closer the stop, the more shares I can buy. I usually set a profit target. That profit target, when the market is tough, is 1 to 1. Sometimes I'll raise that to 2 to 1, meaning I like to make twice what I'm risking. But right now I'm at a 1 to 1. When I hit my profit target, I take half my positions and raise my stop to break even. Now, gaps happen. And when gaps happen, usually around earnings, you can get burned. But if you're now at a break-even stop and taking off profits, it's hard to lose money on most trades. When I hit 10% or so profitability, I will change to some type of a trailing stop. I like a chandelier stop. A chandelier stop is like a trailing stop, but instead of being a fixed percent, it has to do some with volatility. And my +1, and this works for me, I'm not saying it works for anybody. On my big winners, I change to a mental stop. I have a stop, but it's mental. I wait to the end of day. If there's been a close below the stop, I set an order to sell the next day if I trade below the close of that day. So, why is that important? Or below the stop if the stock recovered. On Wednesday, if I had fixed stops, I would have been stopped out of my Amazon, my Facebook, my Netflix, my Apple, and I would have created my Applied Materials, my AAOI, and I would have created some tax burden. I don't worry about the taxes, but more importantly, I would have been stopped out of my big winners. I don't want to be stopped out of my big winners. I want to make that decision, and what I'm willing to do is give it a day. And if it opens up like they did on Thursday, I don't get stopped out. So that's why my +1. The risk is I lose money because it keeps on going, and then I get stopped out at a lower amount. I mentioned my target varies. So I have my favorite setups. Pull back to support and then break out with momentum. That's my trade. I will buy breakouts. I like bottom fishing. And frankly, sometimes I just can't help the trades, and I got to buy these big winners that I missed. Sometimes look AAOI, I find little pullbacks, pocket pivots perhaps, and I'll take them as a new add-on entry. I couple this with a top-down approach, so I'm trying to do this in the industry groups and sectors that are working the best. And again, as I kind of called out before, I've designed my system so I have a life and I do not sit by my screens every hour of every day. So I hear people go, does he make money? Why doesn't, why does he do this for free? Well, I think I told you I do it for free because this is my way of giving back to Ian and Ian's memory. I don't normally do this because, frankly, it's none of your business. I've been very successful in business. I have a fair amount of money that I don't worry about, that I let other people manage or in long-term accounts. But I do, within my terminology of aggressively trade my account. And, I don't always win my trades. As I said, I have a tendency to let some losers turn into big losers, and that's where I have to do better, and that's typically a stock that's made a lot of money, and then I've given back a lot of the profits. For example, holding U.S. Steel, buying it at 5, getting it up to 32, 34, 36, and then selling some, but holding some as it's dropped back down to 20 because I believe too much in it. Those are the things I have to get rid of. But when some guy is out there hawking stuff, and then tell you it doesn't work after he called it the best indicator ever and he lost, 2/3 of his trading account in 2 weeks, there's a problem. So does trading cancel him and having a life work? You tell me. Right now, my trading account has about $2 million in it. I use my trading account as an ATM machine. This is what I live on. I do have a business and I do draw a salary, and what I make, I give it to my wife, and the rest I live off of this. I have some pretty big drawdowns if you take a look, and there's the U.S. Steel drawdown is giant. But then again, you look up and you'll see some pretty big wins as well. 500,000 on Amazon, and that was a trade. I didn't buy that at the IPO, believe me. But all that should matter is that, am I profitable? I'm carrying a gain of close to $1 million on this account, but that doesn't mean anything. It could be all long-term gains. It doesn't mean. This is what you should look at. And if you look at your own account, are you up or down? And you could see on my 2 million base, and when I started the year was at 1.8, I'm up over 700,000. So what is that? Is that a 40% return to date? That's what it sounds like to me. Enough. Again, I didn't do that to beat my chest. I didn't do that because I want to show off. People who've been here before know that I've been successful in business and I have a big account. I probably trade differently than many others because I have the cushion of a big account. But the most important things here are, one, be careful of who you listen to. And as I said right here, you've got to become your own guru. No one cares more about your money than you do. I don't want to manage other people's money, so don't ask, because once I do, I will change and I will lose money because it won't be able to trade the way that I like to trade. Find people you trust and learn from them. And you don't have to day trade options, futures, and stocks and be at in Forex and be at your computer all day long, every day, to make a good income. And frankly, I'm at my computer the weekends I kill myself because I do a lot of work to prepare for these videos. During the week, it's 20 minutes. I'm at my computer during the day. Sometimes I typically trade off my iPhone, and most of my trades I put in the night before. So just a few thoughts, and yes, I have bought everything on the market, and enough of that. And for those that was too much information, I apologize. I just got really ticked when I listened to that video or webinar this week. End of day Friday sector review. Healthcare is weak. I've called it out a couple times over the last couple of weeks. The trouble with biotech is you can always find a stock like AERI that had a great on Thursday and Friday on news, but as a whole, just look at Celgene, Gilead, Biogen, like I did last week, Alexion. Until those stocks firm up and turn around, it's a tough place to be. Other than that, bank finance, mixed at best. Materials looked very strong. Energy mixed as well. And I use this during the day just to get a barometer of what the market's doing. Now, am I bullish? Am I bearish? It's hard for me to be very bearish. As I said last week, look at these charts. We had a big correction, and 2 days later we had a new PPS buy signal, and we're at new highs, whether we're looking at the E-minis, the NQs, and the YMs. The YMs haven't yet, I guess, set a new high, or else I'd have the white bubble opening up here. But all of them are near or at their all-time highs. The Russell has been struggling, and frankly, the Russell's been sideways for months. The good news is it's sitting on the 17-day. It's above the 50, above the 200. The VIX, we had a couple-day wonder, and it pulled right back. John Person pointed this out to me the other day. Look at the volume in the VXX. It's freaking unbelievable. He thinks a lot of people are hedging their portfolios by buying VXX options instead of puts on their stocks. And the dollar bounced up a little bit on Friday, but on the week was fairly stable. But you could see the dollar's really dropped considerably. And that's impacted certain things, although gold's rally has been, I think, kind of weak considering what the dollar has done. If I look at weeklies, again, how do you, same indexes, how do you feel bearish when you look at these top three? We're in long-term buy signals across the board. The Russell is the one that's the least bullish, and then the VIX is low and the dollar broke through support. And then sometimes I like to look at my Genesis charts, and I'm not going to spend time in them, but they actually incorporate seasonality and a number of other things. But the message I want to give you is so we got this stack here is the E-minis, this is the NQs, this is the TFs, this is the New York NYSE, and then this is the YMs, the Dow. Whoops. And what do you see except for the TFs? We just did a major upthrust after this pullback day. On weeklies, we are in a buy signal on everything, it looks like. And on monthlies, we're also in a buy signal. So it's hard for me to be very bearish here. Obviously, this market isn't going to go like this forever, but I expect to see clues before it rolls over. The next slide are my, quote, clues that I'm looking for. I'm looking for things that are tipping me off. I start with interest rates. They're, well, I won't say they're down again. They're kind of flat. But to me, the rates are low. And the low rates probably suggest the economic news isn't great. And even though we expect the Fed to raise again in June, there must be some doubt about that because the rates are not rising into that. I don't expect to see a massive tightening, or rates would be higher. And the other thing is, low rates may be good for certain things like home builders, MLPs, REITs, dividend payers, etc. But low rates are not helpful for banks, especially regional banks and insurers. AD lines, you can see on both the Russell 2000 and the Russell 1000 that we've got new highs again on AD lines. Ultimately, they're going to roll over. I would expect the AD lines to roll over, maybe on balance volume to roll over in the major indexes before the actual index rolls over. So I'm looking for divergences. I don't see any. I look at breadth, and I see that we're sort of stuck in the middle on stocks above the 200 and above the 50. So I see no signal there that we either overbought or oversold, and therefore no signal that this market is about to change. This one's probably been the fastest reacting change, and it's a 13-week or 3-month new high, new low index. And when we get up near the top, we always see the market pull back some. Sometimes they're very sharp pullbacks. We're right in the middle here. Yellow is last week, green is this week. So again, no evidence that this market is overheated and ready to roll over. If we look at the McClellan, we actually broke through the zero line on the daily, the weekly as well. And you could argue that we have higher lows, but we also have lower highs on the summation index. So I think that we keep going higher in the indexes. We're really not making highs on the McClellan. Again, further proof that this is not well, perhaps overbought might be one word, but over-participated. There's still some lack of participation at these highs. Buckets. This basically for newbies. I take, taught by Ian, made automatic by EdgeRater. You take the 1,500 stocks in the S&P 1500. These were the S&P 1500 as of 3/12. I ran this on Friday. Imagine I take Bollinger Bands, and between 0 and 100, I make 10 slices of the pie. I add an 11th slice for below the Bollinger Bands, a 12th slice for being above. And what do we find? We find that we have about 8% of stocks are above the Bollinger Band, but it can get to 20 or 30 before we're overbought. Clearly, I have more green than I have red. But when you look at the 50-50 line, you're pretty much equal stocks above and below the midline of their Bollinger Bands. Again, no evidence that we have to correct here. The Hindenburg Omen, talked about it a couple weeks ago when we started seeing them. We haven't had one in a couple weeks. That's a good sign. The Hindenburg Omen is a signal that is made up of new high, new lows, number of highs, percentage of new highs, McClellan, and the weekly moving average of the NYSE. When you start to see the Hindenburg Omen fire, then it suggests that you may have a major correction. There has not been a major correction in 50 years without the Hindenburg firing, yet most of the Hindenburg omens will either be very teeny-weeny pullbacks or none at all. Market tone, we look at this third column. Green is bullish, red is bearish. When it's no clear color, it's in chop, and we are in chop. Hard to make money in chop. Fortunately, this chop is overall, but there are some stocks that are doing extremely well. Sector strength improves. And the reason why I said that is we now have got technology, utilities, and staples in the green. Energy is in red, the rest is in yellow, and you go back 5 days or so, we had a lot of red there. So that shows that even though the market is still lingering in chop, we are improving in some of the sectors. Now, where all the money is, frankly, is in the canaries, and they broke out to new highs. The canaries are Apple, Amazon, Netflix, Facebook, Baidu, Google, and Priceline. The big dogs of the NASDAQ 100, they have clearly been where the money is. The money's been moving, and they're strong, and frankly, I've got most of those in my portfolio, hence why I've got the good performance, despite some failed money management on a couple of positions. And like I said before, none of us are perfect, and my issue is sometimes I get married to the story. I've got a pretty big position size, and I've given it too much room to grow. Now, the other part is, if I go back to that U.S. Steel, I'd had puts that I had protected my position, and I took the puts off, so I made profits on the puts, which I should have told you before. But that made up for much of the stock loss, and I still should have gotten out of the stock. But bygones. Know your news and your earnings dates, and you could see them listed here. This is from Bloomberg's economic calendar, and I point out what's important here. Well, Monday's a holiday. Tuesday, you got some Schiller Index, consumer confidence. Wednesday, Chicago PMI, Red Book, Beige Book. Thursday, you've got some unemployment, job claims reports, PMI. And Friday, you've got the first monthly employment report. So those are some of the biggers. In fact, Friday's usually the big mover. I think everybody expects a rate hike, or 85% of the market, come June, middle of June. So I'm not sure that a big number is going to spook the market too much. Weakness might make people think the rates aren't going up. And then the rig count on Friday. Not a giant week for earnings. However, Palo Alto Networks, Broadcom, Lulu, are some of the ones that are big. Ciena, they're big if you own them. If you don't own them, they're not so big. And one of my favorite quotes that I made is, it's a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. No follow through the downside after the May 17 one-day drop. Most indices have now moved to new highs, although Russell is still struggling. No evidence that the market is overbought. FANG still has teeth. Technology is driving markets higher with interesting partnerships with defensive groups, utilities, and staples. I don't mean corporate partnerships. I mean they've started to join utilities and staples along with tech. Maybe that means tech's going to run out of steam. Top-down investing with rotation to strongest industry groups has outperformed as we climb a wall of worry, whether it's terrorist attacks, politics, rate increases, ACA appeal, Trump budget, or tax reform. This market seems resilient, but let's also keep in mind that the seasonality is getting weaker. Tonight's agenda, intro comments, which I've probably made too much, market review, and then top-down analysis and a bottoms-up. You can probably tell I'm a little bit pissed this week, and I really am, because I got one guy out there claiming to win 25 money championships. I'm not sure trading for an hour and trading one lots on a futures really reflects what most of the people who I know actually do. And what they don't always tell you is some of these championships are against one other person. Just some of the fluff out there and the promotional things. I mean, maybe I'm just getting cynic in my old age, but come on. All right, maybe I should charge money for this, then I could be just as bad as them. See you in Florida. Let me just comment about that. John Person will be doing a meeting around November 30th, I think in Palm Beach Gardens at the Hilton Garden Inn. I'm going to try and clear my schedule. I'll definitely attend the weekend components, but I'm going to try and do an HGSI Doc Live where I'll show you how I trade and teach how the things that I learned from Ian on the Friday of that weekend. So a couple of things that you can do for me. For those who forgot or don't know, there's my email address, hgsidoc@gmail.com. If you'd be interested in attending either mine or John's seminar or both, please let me know because I need at least 5 people for me to bother, and it's not financially. I've yet to make money doing a live seminar because, frankly, that's not why I do them. But if I don't have at least 5 people, it doesn't make sense for me to spend the time. Second thing is, if you're new to HGSI and you want to see some videos on how to use the program, I've got a dated 6-pack that go through each button. And then the third part is, if I lose you in the next hour on my terminology and you would like some help, email me and I'll send you a presentation I gave that goes through all the indicators and their names. On that note, I'm going to go grab a soda. I'll be back in a second. Put it on pause. All right, one thing I should also point out is there are 3 numbers across the bottom. One, the top number, which was a big number, about minus 700, that's my margin. I am deep in margin, which I do when I'm bullish. The second number was my profits this year, and the third number was available cash, which there's still some cash in that account. A lot of that margin is because I do a lot of put selling to generate income or put spread selling, and that really pumps up my the profit dollars, although it does eat up margin and increases risk. And the other thing is, just going back to the U.S. Steel, if I look at my losses are typically I buy too much insurance. And so sometimes I'll take profits on the puts. And on most of my long-term positions, I will do different types of collars around earnings. If I will sell calls that are way out of the money, I'll buy a put that's at the money and sell a put that's below my downside target if there's an earnings miss. And I can mitigate a lot of my losses that way. Sometimes I will buy puts on stocks because I'm concerned when maybe I should be selling the stock. But a lot of my profits and losses in the short term are trades around my core positions. And that does require margin. All right, so hopefully you're still with me. So now I usually jump into TradeStation and I do my 5-point analysis to determine what the markets are doing. So I made this up, but it works for me. 5 points. Point number 1, where am I in a person sell or buy? I'm in a PPS buy on the ES. Okay. Number 2, what color is my paint bar? If it's green, it's bullish, I can buy or hold. If it's blue, it's neutral. If it's red, it's bearish, I can only sell or hold. It's green, so I could be buying or holding. That's 2. Number 3, am I within the envelope? I am within the envelope. Notice I went up to the envelope and went sideways on Friday. So that's 3 positives. Number 4, is there any evidence of divergence or convergence? Are there red dots above or green dots below? Here's where the dots were. The pullback, I gave up the convergence. There's none of that, so that's 4 positives. And then on my high jump bar, am I extended? I am not extended. So I look at the E-minis on the dailies. I'm 5 for 5 bullish. I'm in a weekly buy and a monthly buy. Again, a reason to be bullish in the market, but always cautious based upon the time of year. But trade the market you got, not the one that you think you should have. YMs, green, arrow, green bar, no dots within the envelope, 54%, and weekly buy green and weekly buy blue. YMs also look strong. TFs. Interestingly, TFs went to a buy with green bars on Monday within the envelopes, no divergences. and 32%. So the daily looks great for the TFs. This is the short-term problem is we're still in a sell signal, although we did have a new green bar, so maybe that sell signal's at risk of going away quickly if we have another up day on Monday or Tuesday. Monthly, we're in a blue, but a long-term buy. So I look at the Russells. They look better this week, don't they? And then lastly, I look at the NASDAQ, which is the NASDAQ 100 for the futures. So you can guess what that's going to look like. This one is bothersome. It's bothersome on a number of fronts. One, it's in a person buy. Awesome. Two, the paint bar is green. Awesome. However, three, I am above the envelope on both the daily and the weekly. Four, I've got MACD divergence setting up on the daily and on the weekly. And five, I'm at 100% of the high jump. Typically, you don't have to see a massive pullback, but when you get this extended, you expect it to go sideways and get back within the envelope and work up some of the over-exuberance at the minimum. So I'm a little worried about the NASDAQ. It needs a breather here. It doesn't need a correction, it needs a breather. Now let me just show you these dots because this is really cool. It's an indicator from Alexander Elder. See what I want, trend line. So you notice between here and here, we're definitely down, but between here and we're higher there. So you've got a divergence between price and the MACD histogram. And when I see that, that just tells me that some of the pressure pushing this market up is abating. And it suggests to me that we're at risk of, again, sideways, maybe a pullback. The high jump at 100%, that means the extension from the 250 and the 17th is the highest it's been in the last year. Well, you know, it's usually a reason why it's the highest because it doesn't stay there very long. You got that same MACD divergence on the weekly. I think the NASDAQ looks like it, you know, it could keep running. I'm not saying to run for the hills, but it looks like it needs to slow down and go sideways at worst or best. Dollar, we know that's weak. Although interestingly, the dollar, green dots that showed that you're getting some, let's see, we have to compare it to, I guess, wherever the prior low was. Well, certainly from here to here, you have a clearly a lower dollar. And on just what I'm looking at here, at the minimum, you have a divergence there or convergence, a positive divergence or convergence on the MACD. Isn't it nice? I just have to look at the dots. I don't have to look at the lines. The dollar, 11%, is pretty low on the high jump bar. It's actually a signal that I look at and I scan for in Genesis for stocks that are making an annual low from an overextension because they bounce, you know, there's a reversion to the mean. You're still in a weekly sell and a monthly sell with red bars. So we're not out of the woods on the dollar, but it did firm up at the end of the week. Notice it got below the envelope and popped back in right away. Oil, been up and down, had a nice recovery into the OPEC meetings, and despite extensions of the cuts, they must not have been enough for some people because oil's in a short-term sell, and the dollar is weak, so that means yellow metal, gold should be strong, and it is, but you know, reality is, yeah, this chart doesn't look bad. You've had a nice move up here. But when you look down here and you look at where we've gone since 2012, we haven't even taken out the 16 highs. You still got a long ways to go in gold. So what's my summary there? Markets look strong. NASDAQ looks a little bit overdone. But, you know, overbought markets can continue to be overbought. But something tells me that when this market breaks, it's going to break hard. If I look at my top-down view and look at just price and volume, where's the strength been, raw combo rank? Dow, transports, NASDAQ, NYSE. Man, when you see that up at the top, you know the market's strong. Russell 2000, biotech, volatility, dollar on the bottom. Interestingly, S&P 500 down here as well. If I look at a 5-day move, transports were up 3.3. The big loser was the VIX. And biotech was down only a little bit less than 1%. All right. Now let's take a quick look at some of our favorites. S&P 500. What can I say? Let's go to the simpler view. Weekly bongo, which is my buy-sell indicator, is green. Daily bongo, green. Last Hindenburg was up here. A single Hindenburg doesn't bother me. It's when I see a series of them that I get excited. No kahuna or no phoenixes or eurekas, and the last kahuna was back on, I guess, Monday. So S&P 500 looks great. How great is great? Well, if this was the low here when it pulled down to the 200 to where we are today, this is from the election. We are up 16% in 139 trading days. A super strong market. Continues to look strong here. Nothing not to like. If I look at the Dow Jones Industrial, looks great up here. It's 8 above the 17, above the 50, above the 200 on the moving averages. The bongo's green. Not much to say any different. I look at the NASDAQ, which should be the strongest of the bunch, and breaking out to new highs. The NASDAQ, since the bottom, (23% in 139 days. And oh, by the way, the guy that had the big drawdown the last 2 weeks, no surprises, down on the year. Wow. I mean, this is just an amazing market. And then where is it weak? Let's look at the Russell. I brought this box last week. We're still in the middle of the box. As I said, the Russell's been sideways almost. Had an initial run up from the election of 20% in 25 trading days. And then from there to here, we're over the last 114 days, we haven't changed. So I look at that and I see a relatively quiet market and the Russell going sideways. If I look at the dollar, we know what the dollar is going to show. The dollar is sold off hard. It bounced the last couple of days. Look at the resistance overhead. First of all, the weekly bongo would have been a great signal to get you out of the dollar as it crossed below the 50 here at about 26 and change. Pull back down here. It's bounced a couple of days. Lots of resistance to get through. The VIX, as I called it, had a couple-day wonder and failed at the same point it's failed last time in April. You lose money if you're long on the way up. You make money on the way down. Hopefully you made some good money the last 2 weeks. Gold. It looks a little bit more compelling. It's, again, I drew these trend lines saying maybe we're in an uptrend. And, within this uptrend, we got a flag. And we're right in the middle with the gap up on Friday. The weekly bongo went green. So maybe gold is a place to be nibbling. I have no problem with that. I'd set my stop down around that 200. The challenge is it's got to hold above. The 200 was support on the way down, and it's been resistance on the way up. A hold above the 200 would be very constructive. And then if I look at the silver, to me it looks worse than gold. The bongo's still red. All right. Next thing I do is I go to 07, which is the industry groups. You can see I've got 173. Momentum to the upside, I got 61. Momentum to the downside, short term, I've got 10. Now notice what's in the downside. Some of the things that I've been relying upon: REITs, banks, healthcare facilities, large pharma, cement, renewable energy, wealth management, generics, have been strong groups, and at least over the window of a 2-day EMA on the force index, these things have weakened. Where is the strength in the market? Well, semiconductors have been incredible. I hope you own some of these. I've certainly called out these things enough over the last many months. We'll start with the big kahuna right now, which is NVIDIA, and let's drop it down. So I'm just going to break down what I like about this chart and why it's potentially even a new buy here. First thing is, I look up at my color bars here. Remember, green and blue are good, red is bad. I start with my weekly bongo. The weekly bongo would have got me back in the stock at about 128. We're now at 140-ish. Weekly bongo is green, that's a buy signal. Accumulation distribution, it's accumulating dark green. The 2-day and 13 and 2-day forces are green. The high jump bar is nowhere close to the top. You could see here it hit the top, and what did it do? It pulled back some. Here it hit the top. What did it do? It went sideways and pulled back some. We're not at the top. This is a Bible gap up. This would have been an interesting day to get into the stock right here with the Bible gap up. The yellow are squeezes. We're in an uptrend. We're not squeezing. And these are mobile breakouts from David Elliott. In my price window, this here is the industry group, the dark gray. It's moved up a lot since November. Candlesticks are obvious. Magenta is an 8-day exponential. Then we have a 17, a 50, and a 200. Simple moving averages. This is a pocket pivot. This here is something called on-balance volume, which I use instead of regular volume. And this is a kahuna. Blue kahunas are a big move to the upside. A red kahuna is a big move to the downside. The darker, the bigger the move. And then this here is a phoenix. The green is a eureka. Those are basically the HGSI equivalent of follow-through days, in green to the upside and red to the downside. So here we have a stock that's lower left, upper right. It bases, it pops. It bases, it pops. Obviously, it's going to base again. Right now, it looks very bullish. We've had a couple of days of sideways moment and a pocket pivot. This could be an add-on point of NVIDIA. Marvell Tech, I like this one better for an add-on point. It broke out with a Bible gap up on Friday. Look at the volume coming into the stock. Earnings are not due until September, so they probably just came out. Everything is green, not quite at the high jump. I think Marvell Tech looks great. AAOI, this one gave me one of my favorite times to buy, which would be right here. And I got long here. I did one of my favorite trades. So let me show you what that trade is. All right. Actually, I'm going to go kill my totals. Hold on. All right. So I wanted to hide my totals, which I just did. I've shown that to you enough today. Let's look at AAOI. What I did is I did 2 bullish trades. I went long with a at-the-money call, a $55 September 17th $55 call, and I paid a lot of money for that call. I'm up. I must have. Let me go look at my phone. Well, let's see. Let's see if this is going to work. Pause it. All right, I'm back. So here's the 3 trades that I have on AAOI. And so what I did, let me go back to my chart. I bought it, I probably bought it on this day here. And the reason why I bought it was I have a new weekly bongo green. I had a Bible gap up, a Mobo breakout, and a kahuna. coming off the 50-day moving average. So the trade that I took was I could have gone long the stock, which would have made sense, but at $56 a share with a stop around 50, 4,000 divided by 6, I could have bought about 700 shares. That's not very sexy to me. I could have just bought long calls at the money, which is a very popular strategy that I do. Or I could have said, I'm really bullish. I'm going to buy a long call. I'm going to sell a bear put spread. So that's exactly what I did. So I bought a long call at $10.11, and it's now up, doubled, with a return of $33,000 on this one trade. I sold a put spread. So in red, I sold this for $660. It's now worth $540. The $455 is worth $396. Now I had here a $2 credit. So I was able to reduce my cost from 10 to 8. And so what I typically do is I then, once the stock moves, I try to sell these. Now I don't know why these have not dropped down. I know why. Volatility remains high. And I'll come back here. Let me pull. And you could see I've got an order sitting out here to dump these at $1.35, well, at 40 cents, because, hell, they're $15 out of the money practically. I don't think, 15, it's $16.50. And so 20% out of the money. I'm not going to pay anything to get rid of that put spread. I'll just let it expire, and I'll keep the delta between the two, another $4,000. The other thing you may have noticed, there was a pretty big loss on Amazon. What I typically do on Amazon is I have a long position, but this account I play options. So I keep rolling this 830 call forward, and I sell puts against it, or sell calls against it. So I'm down on this, but I'm fine. If this goes all the way to 1050, I'm not going to care if I get it called away. That's sort of the goal. So some of my big losses are actually option positions against a long position. So this was a call spread. So by, I don't think we're going to get to 1050. If we do, it'll get called away unless I do some type of a repair strategy, which means you take a loss on one and sell a different one. There's no such thing as repairing in options. Back to the story. So AAOI, I bought it off the 50. It's been a nice profitable position for me. Micron, what a beautiful lower left, upper right. Looks like a great buy position. Look at the earnings per share coming in. You can see this here in red is the revenue, blue is the earnings. It bottomed here. You see the bottom. And now it's blasting off. What a great time to be looking at Micron Technology. Here's the index. A couple of others that I like in here. This one looks interesting. This is my typical get on a plane trade. So let's work this up and show you how I look at things like setting my stops. And if I was to put a trade in. So I'm going to new. So I'm going to show you how I didn't just do that, did I? Hold on a sec. As I said, I've bought everything on the market. Trouble is, most of them suck, except for learning chart patterns and being educated and knowing how to trade and not relying on other people who care less about your money than you do. This will be a long one, but it's a holiday weekend, so I'm going to keep going. You could always, I probably lost you already. I showed you my performance, but just move this thing out of the way. All right, you're not going to cooperate, so we'll do it this way. So here's my get out of trade. This is how I look at my trades. Chemet, let's bring this up here. Is that what I want? Great earnings per share growth. Would you agree? next 2 quarters. Multiple much less than the earnings. I'm going to drop off 16 cents and add 43 cents. That's 27 cents of new earnings. If I leave the 36 PE, that's $9 of extra value that could come in. Well, what'll probably happen is the PE won't stay that high. So I like the earnings per share growth. Clear uptrend. We've pulled back to support. We're right below the PSAR dot. That is one of my favorite setups. So let's look at how I would trade this. This tells me where everything is. Let me make this a little smaller. All right. So I'm going to put a buy stop at right above the PSAR dot. The PSAR dot is at 1422, so I'm going to put my buy stop at 1430. Okay. And why am I picking that? Because there's a trading system called the Wells-Wilder trading system that you buy it when you do a PSAR reversal. That right now is resistance. It turns into support or a stop after I cross through it. So I'm going to put a green line a little bit above that dot, and that's my buy. Where would I put my stop on this trade? Not as simple. I would probably, the 8-day exponential, depends how much room I want to give it. And that's potentially a problem with this trade. It was a better trade right there, similar pattern. I'd put my stop typically underneath the lowest in the last 4. I could move it up to that 17-day moving average. But I'm going to put my stop under here, which is 1258. Now, I may decide not to take this trade because the stop's too wide. So my stop means my risk is what? It's too much. I wouldn't take this trade. I'm just going to go through the example. So my risk on this trade is 1430 minus 12, say 55, equals $1.75. Divide that into 14.30, it's 12%. I would not do a 12%. I'm unlikely to take a 12% risk. All right. Now, how many shares could I buy? I could buy 4,000 on a $200,000 account, divided by the stop, which is $1.75 equals, so I could buy 22.85. And that would basically be the ticket I would create. I put a buy order to buy it. If it tapped my green line, I'd immediately put in a hard stop here. And then once I've got a 1-to-1, so that would take my target up to about 16, I would raise the stop to break it even. In a stock that's this far above the 50, that's not unusual. And that's how I basically work up my trade. Get out of plane trade because I could set that trade, get on the plane and head up to wherever I was going and not really worry what happened. So Kemet came on my screens this weekend. Anything else that looked interesting here? A lot of the charts look good. So semiconductors look pretty good to me. In HGSI, everything I show you comes free with the program. Now let's go second group down is publishing and broadcasting. That's weird. We don't usually see that. Sirius XM1 actually looks pretty good too, doesn't it? You had a kahuna on Wednesdays that broke the 50. Everything is green here. You got volume coming into the chart. OBV looks good. Sirius XM1 Holdings looks good. Float 6% short. So that could, if you got a short squeeze, that would propel it. That's at an interesting buy point. Don't know anything about Tegna, too low in the pattern. This is Liberty's shares of Sirius X1. I don't understand the business ownership rules there, but a very similar chart. So it's really about Liberty and XM that are driving that group. Apparel and footwear. I have a problem with this pattern. It's probably interesting to some. It's a buyable gap up, and there are rules from Morales and Catcher about trading buyable gap ups. It's sitting right under the 200-day, weekly rather, which I think is going to be resistance, and I'd be careful. So I wasn't interested in chasing Deckers. PVH, Nike. This group doesn't look very hot to me. Skechers looks interesting. It had a kahuna sitting on the 200, but the weekly bongo's still red, and I've not done well trading this stock. So apparel, footwear, and design. This is one that's moved up this week. I don't find a whole lot that I like in that group. Application software. Talk about great stocks. Viva Las Vegas. So where would you want it to have bought Viva? Hint, free parking is the 50-day moving average. Every time this stock pulls down to the 50 and gives you a kahuna, you want to buy this stock. All right? Every time you get the 50 and a kahuna, you want to buy this stock. We're not at the 50. We had a buyable gap up. It's extended. You can see it's hit the top of its high jump. Great company, big PE. I'd probably pass and look for a pullback. Not a great time to get in. Intuit, don't like its earnings. Salesforce. This one's a big mover. We hear about the cloud constantly. I can tell you in my business, we would be dead without Salesforce. It's a little bit extended. Where did you want to buy it? You wanted to buy it down in here. It'd been a lot nicer to buy it off the 50. If you had had a signal then, it's a little bit extended. I'd wait for a pullback. Buyable gap up on web.com. I think they're in some takeover talks. The last couple have been too extended for my taste. All right, and I go down the list of the top 10, internet media. It's funny, one of my biggest losses turned into a win here. Only reason I got a big Facebook position is because I had sold some $60 puts. And let's see if I can. I don't even know if I can bring that up. Let's see. No, it's blocked. I got hit by the $60 puts actually filled, which is not actually good news for me. It was pretty bad news at the time. Looked like it was a nice uptrend and safe, and I had bought some out of them, sold some puts, and the stock got put to me, but fortunately I held on, and the stock is worth a lot of money. Nice uptrend on Facebook, not overly extended, looks to me like it wants to run again. Google, obviously very extended like Amazon. Now you have a race who gets to 1,000 first. These guys are Amazon. Cena, also like Google extended. I'm looking for stocks I can buy. I'm not buying Twitter. Here's one that I have, and it broke out on earnings. This is Weibo, also extended. You notice this pattern looks the same on all these stocks. That one's a little messier, but you go back to Alphabet, it's the same exact pattern. So these stocks have been strong, probably a little bit extended for my taste. Auto index, can you say Tesla? This is either incredibly undervalued or a bubble. I have no idea. As a car company, it's a bubble, but it might be undervalued when it comes to what Elon Musk, who's a true genius, is doing. Great move. Again, to me, it's too expensive to buy from an earnings per share and fundamental perspective. GM changes CEOs. Tata. I don't like anything there. Clearly, it's Tesla driving it up. I'll go through the top 10 looking for stocks. This one intrigued me, Pure Storage. I shouldn't tell you about this one because I'm going to probably buy it on Monday. I don't want you to front run me. What did I like about Pure Storage? It's not a pretty picture, let's be honest. It's a IPO that was as high as 20, that traded down to about 9.5, and this is a weekly chart breaking above the 50 weekly moving average. On the daily chart, I have a break above the 200. I've had 3 kahunas in the last 4 days. Volume is coming into the stock. I've now got a daily bongo. The earnings suck, so I took it over into TradeStation. And I threw it into PSTG, into this. And what did I see? I saw a weekly high close doji. Weekly volume looks good. John's market catcher turned to white, and it just, I think, turned positive this week. That's good. A new PPS buy in daily and weekly. Great OBV. Market catcher daily looks good. So now let's look at this stock, and can I make the numbers work? And that's going to be the question. Let's pull my little notepad up. Let's see, how would I play this stock? This is one I'm interested in, so I'm taking this time because I might do this anyways. I would have to buy this if it a move above the current high. So the high on Friday was 1280, so I'm going to put a buy at 1285. I'm going to stick my stop right below the low of the day. Frankly, if it moves back below the 200, I don't want to be in this stock. 1177, I'll put my stop at 1175. Again, this is too big of a stop. Means I'm risking $1.10. So $1.10 into 1285 equals 8.5%. That's not too bad. And my stock and my shares will be $200,000 account, 2% risk, so 4,000 divided by $1.10. So I can buy 3,600 shares. Now I'm going to pause it for a second and go do another analysis for you. Sorry for the length of time. Again, you can always hit the stop sign. Okay, we're now looking at within VectorVest, they have a product called Options Pro. And what I wanted to show you is how I start to think about when it comes to constructing my trade. So if I'm looking at Pure Storage, this is not a great example. It's too cheap of a stock, but it does have options. I'm interested in going long, so I'm going to put in only long trades. Long stock, long call, short put, bull call, bull put, or a synthetic. These are some of my favorite trades. If I was to buy the stock, this is my P&L curve, the blue line. Stock goes up, I make money. It goes down, it makes money. My break even is the price I buy the stock for. Current price is $12.74. To buy 100 shares, I've got to pay $1,274. All I can lose is $1,274. My profit potential is infinity. Now, I like infinity on profit. I'd like to limit my risk if I can, or limit my $1,274 out of pocket. All right, if I bought the call, so I'd have to buy one call. Well, one call would buy 100 shares of stock. So if I bought one call, it's a little different picture. I have an infinity gain. That's nice. I have to get to $13.13 before I break even because I have a cost of a call, which is $62. The most I can lose on this trade is $62. So for the same, for half the investment, for $62.50, I control 100 shares, or 60, $12.74 to buy 100 shares. For $62.50, I control 100 shares. I get the gain on this stock minus my premium. I can only lose the amount I paid for the call. So to me, this is a less risky, except the stock has to move in my favor for me to break even. So out of pocket is good. Maximum profits are good. The maximum risk is limited. That's why people buy calls. All right. I could buy a bull call spread. The bull call spread, I now reduced my cost from like $67 to $55. That's the most I could lose. So I've reduced how much I could lose. The problem is I've capped my gains. If I'm bullish, like that Amazon trade that I showed you, I've capped my gains at $250 on that trade because I sold a call to offset the long call that I bought. So you reduce your risks. Now I only got 55 at play, not 67 or 1,274 if I bought the stock, but I've capped my gains. So if this stock got taken out for $22, I'd be really pissed. But that's not a bad trade. I like to do a bull put spread. And in a bull put spread, what I'm doing is as long as the stock goes up, I make money. So I get paid $38 for this trade. I'm risking a loss of $212. So if the stock moves down, the amount of my premium down to $12.10 or $12.13, I lose money. But between $12.13 and $12.74, the current price, I make money, and above the current price, I make money. The bad thing about this trade is I have no upside, no upside opportunity beyond the premium that I collected. So I don't like that trade. High probability of winning. I'm going to come back to this trade. So let me keep that trade down there. I could just go short a put. This is how I got my Facebook. And in this one, I get $40 credit because I'm not buying protection. I have risk all the way to zero. I don't like that, so I got $1,210 risk. And I've maxed my gain at the $40. This is why I don't love selling puts, although you do put the money in the pocket. So I don't like that trade. Then I have one of my favorite trades called a synthetic stock. And remember the P&L curve. All right, why are you doing that? Come on, don't freeze on me now. All right. There we go. The P&L curve on the stock looked just like this, didn't it? But it cost me $1,274 to get in. I can do the exact same trade for $22.50 and control 100 shares between now and expiration in June. I could change it to July if I wanted to. The advantage of this trade is I don't have to put $1,274 in it. I only got to put $22 in it. I have my infinite gains. That's great. But I can still lose everything. Not so great. So remember, this is the synthetic long the stock, while this is long the stock. Same exact curve, but it cost me $1,274. So let me show you what I like to do. I'm going to combine a long call with my bull put spread. So I'm going to let this thing reset. Come on. I'm going to add an option leg. And I'm going to buy an at the money call. $12.50 call. Okay, so what just happened here? I'm now going to have to pay $24.50 for this spread. That controls 100 shares. My maximum profits, this looks just like the stock. If it goes up, I make money. Whoa, I like that. My downside is capped. I like that too. Ooh, I like that. So I've capped my downside risk. I have an infinite upside opportunity. And it's only cost me $24.50. Now there's another thing here that you have to be aware of. You have to have margin. So the margin cost on this is high because I'm going to have margin between these two, which is $2.50. So what I'm likely to do is I'd probably buy 50 contracts, which would put maybe $12,500 a margin requirement for this trade. So if I compare this spread, let's see if I can do this. Copy the primary spread. And then I compare this with long stock. Okay. Notice, and then I compare this with a long call. And I compare this with a synthetic long stock. So what I have here is $24.50, unlimited profits, maximum risk of, let me make sure I got the right one here, yep, of $274.50 on 100 shares. And this is where the risk comes in. On the long stock, I have maximum profits are the same, but I risk $1,274. What's more risky, to risk $1,274 or $274? I'll take the $274. The difference is I have a time duration that I don't have on the stock. If I did the long call, if I did the, sorry about that. If I did the long call, it's cost me more money. I have infinite profits, and I'm only risking $62.50. So buying the long call doesn't have any impact on my margin except for the cost of the call. And that synthetic, which I liked as well, the problem with the synthetic is I had the big risk. So this is my favorite spread. And what I probably would have done here is I'm not going to buy the June. I'm going to look out at the July. Give me a little bit more time. Hit OK. And the July spread is going to cost me $32. To me, this is a safe trade. The most I can risk is $282 on 100 shares. Now, if I play the same 4,000 risk, the most I can risk is 202. Tells me I can buy 15 contracts. So that 15 contracts would tie up 1,500 shares of stocks, or 15 contracts. And what do we say each contract was going to cost me? About, I forgot already, 30, 40 cents. It's cheap. So that's how I look at it. Hopefully I didn't lose you. If I did, come to my meeting. Look at a great stock. We have Western Digital here. Nice move up. Now, sometimes it doesn't work. So I bought some net appliance on Friday, and it came back down. We'll see. The reason why I bought it, it had a kahuna and a pocket pivot on Thursday, broke above the 50, had a PSA reversal, a mobile breakout from a squeeze. I did not take out my stop, which was the lowest of the 4 bars, which would be right here. But it sort of popped and dropped, so we'll have to see what it does. So that's one that didn't work out for me. All right. Next group down, airlines. These have been good the last couple of days. Here's American, sloppy, sideways move. Delta, same pattern. United Continental, Southwest, probably the best because it's truly in an uptrend. Um, you know, none of them are high growth right now. None of them are calling my name. And then look at semiconductor manufacturing to see my favorite holding, Applied Materials. Any guess where I bought it? Yeah, I bought it here. Pull back to the 50. The next day I gapped up here, had a kahuna, a pocket pivot, a mobile breakout from a squeeze. Yes, my weekly bongo was green, and that bothered me, but the stock's been in a long-term uptrend. I took the trade, and it's been modestly profitable already. All right. Now, a couple of things. What I just did, let's just summarize, besides the crap about my portfolio and my ranting about some of the so-called educators. First thing I did is I did a top-down approach. I spent a lot of time looking at the market and what I thought about the market. I'm still bullish on the market, but I'm cautious. Then I looked at what industry groups are leading. It's still technology and a few others that we looked at. I identified a couple of stocks that looked good. I put together a short watch list, picked a couple of trades, looked at stocks versus options, told you how I did my stops, and I'm ready to roll. Now, other things I could have done. I could have gone into, this is basically the designer window, but it's opening up within the warehouse. And you could see there's these things called smart groups. If you go to smart groups, you see my name. This is done automatically every day, every time you update. I can find pullbacks to the 50 moving average with a kahuna. Let's just rank on momentum. Let's take a look at a couple of these. And I know a couple of them look good. By design, these are stocks that have to be in an uptrend, which simply defined was above the 200-day moving average. So it's uptrend, it's got to pull back to the 50-day moving average, and then it's got to launch with a kahuna. Abbott is a life science equipment, medical equipment devices. They got drugs too. 2.4% dividend yield, 19 PE. Looks like a safe entry point with a lot of momentum coming in. Okay. Valspar is a takeout candidate. YPF is, I think, a South American energy play. Look at this. Clear uptrend, pull back to the 50, mobile breakout from a squeeze, a pocket pivot, and kahuna. You'll see that YPF is one of the stocks on my buy list. I don't like the group. Don't remember anything about Adobe Labs. See, this is underneath the 200, so I would pass on it. Don't know this stock at all. Don't like this either. So I like the first two, Abbott and Valspar, but Valspar is a takeout. Another of the smart groups I look at is right here. PSAR reversal to the upside. By definition, these are stocks that are squeezing, so it should have the yellow. They are typically right below the PSAR dot, and each one of these is one of my get on a plane trades. So here's a stock, uptrend, right below the PSAR dot. Now this is a beautiful setup for a safe trade, so I can't resist. I'm going to have to talk about this. Again, you always can hit the delete button and stop this anytime. So let's look at Texas Instruments. All right. Hold on a second. That'll work. All right. So first thing is Friday closed at $81.12. The PSAR data is at 81.47. So let's put my buy at 81.50. Okay. That's simple enough. I put my buy point right above that PSAR dot. Now, I wrote it too high, but it's down here somewhere. Somewhere around 81.50. Where am I going to put my stop? About the low of this bar, 79.45. All right, let's put my stop at 79.40. What is my risk? 2.10, $2.10. What is percentage? 210 into 81.50. 2.5%. And that's the kind of risk I like to take. That's the kind of risk I like to take. How many shares can I buy? About 1,900. So here's a trade that I can make. I think a very low risk trade, to be honest. I got a stock that's in a clear-cut uptrend, sitting on the 50-day support right below the PSAR dot. I can put a buy stop in if the stock trades up. And what do I think is going to happen? It's going to trade up for a few 4 or 5 days. It'll get to my P1. I'll take half my stops there, raise my stop to break even, and let it run. Look at what happens every time it breaks through. It runs up. Not big runs, but runs up. So this is a great opportunity, and I found this on my squeezing with potential PSAR reversal. What's the next one? MGM Resorts. Sitting on the 17th, mobile breakout on Kahuna. That looks interesting. Cirrus Logic. Relative slight uptrend. Perfect buy point. So these are scans that are built in that you can do. Now, in TradeStation, I do a little bit different. I look for John Person signals from my scans there as well. Lastly, what I want to do, I'll show you the things that I thought were interesting for this weekend. Let's go very quickly. Actually, before I look at charts, man, this is a long one. I apologize. Let's look at industries. Semiconductors, e-commerce, computer hardware, communications, and application software. Anybody want to guess where I think the action is right now? I mean, it's very limited. It's limited. Technology is where it's been and where I'm playing until it doesn't work anymore. We already looked at AAOI. Looks like a potential follow-on buy signal as it's gone sideways here. Ultra Clean. God, this was a nice trade. I took this trade, I think I took it on Monday. Let's see. I don't know if I took it. I think I took it on Monday. It's already been. This was a crazy good trade. $50 June 20 calls. It's up 10,000 in 5 days. Let's see where I was. I knew I just. Yeah. Maybe I bought it last week, the prior week. I thought I brought it Monday on this with this candle here, but I have to go back and figure out the dates. But this was a quick trade. Still looks great. Weibo, I showed you earlier. Applied Materials. Viva. I mean, you're running after this, but there are rules about Bible gap ups from Rouse and Catcher. Supernus Pharma, what a beautiful lower left, upper right pattern. Certainly not yet extended. It's orderly. Kahuna, pocket pivot. Mobile breakout from a squeeze. Marvell Tech, I showed you already. Paycom, another nice tight uptrend. Look at Amazon. Will we get? We probably will get the next pullback. We've had some pretty ferocious pullbacks in this run up, but we'll see if it doesn't get to 1,000 first. So I'm tired. Long report. If I offended you by going through my numbers, I did it because I get a lot of questions about whether I make money or not. And also, more important, I got really pissed when I listened to somebody who sells indicators and teaching, and it blew up 2/3 of his account in 2 weeks. I just don't understand. But I guess honesty's good, and he was honest. Goodbye, everybody. Have a great week. Happy Memorial Day. Safe. And a good holiday, and special thanks to those who have served and made this great country the country that it is. On that note, I will say goodbye. God bless. And if you want those PowerPoints or videos that I mentioned, hgsidoc@gmail.com. And goodbye.